Okay, welcome everyone to the Traders for Traders Trade the Time Zone That's Open webinar. Okay, this is probably one of the more important aspects of your trading that I think a lot of traders actually don't understand, or they totally underestimate the importance of the actual time zones themselves. Now, just a quick background on myself. My name is Brad Gilbert. I'm the CEO of Traders for Traders. We've been around since 2009. We are a specialised Forex company. And that sort of pretty much comes from the background that I've had in the Forex industry since 1990. I've worked at Citibank in Sydney, London and New York. Then I've also worked in a number of other banks, Commonwealth Bank of Australia and also Toronto Dominion Bank as head of the FX team there in Asia as well. So my extensive sort of background, what we have done is turn this into or utilise that sort of knowledge to give traders the advantage in sort of trading the Forex market. Now, coming to the major topic here, know your time zones. As I mentioned, this is a sort of key integral part of understanding the market. I think a lot of traders who seem to get into Forex trading or trading in general generally overlook the sort of the small key simple aspects that make up the whole trading system, and the market is one area that falls into that. Now, we all know there's pretty much four major trading sessions, and it starts with the Sydney session at the start of Asia, which leads into the Tokyo session, which is the major Asian or major session for Asia. Then coming into the London session, which obviously is the bulk of the European session, and then leading last but not least into the New York North American session. Now, what you have to understand is each session is unique and has its own liquidity and volatility characteristics, very much like the currencies themselves. Okay, so but just looking at the various time zones and looking at what percentages go through these. So the Sydney session itself is quite small. There's a small overlap between the end of the New York session and the start of the Japanese market, which is the predominant market in Asia. Now, that Sydney session equates to 4% of all Forex turnover. Then that sort of rolls into the major session in Asia, which is the Japanese session, which equates to 6%. Then you've got the European session there at 37%. The North American session with 18% of FX volume turnover. So the remaining percentages there obviously sort of made up with all the peripheral markets. Now, this is going to be a sort of key part to understanding the sessions and why it's important to understand the sessions themselves. Now, the Sydney session as well, just looking at this, as I mentioned, 4% of all FX market turnover. Generally pretty low liquidity and at times extreme volatility. You know, the twilight zone, as it used to be called back in the day, where the New York market shut and before the major Asian session started, the Sydney market was a bit of a stop-loss sort of hunting area. At the moment, it's a bit more of a solid time zone. There's a lot more volume going through the Aussie dollar itself. And the most actively traded currency pairs will be driven by news and data released during that session, namely the New Zealand dollar, Australian and Japanese data. So this is one of the key parts that you have to understand when we start talking about the importance of each time zone. The traders in each time zone actually trade what's in their pockets. Okay, so the Japanese session, for instance, the Japanese traders are more interested in trading the yen and all the yen crosses than anything else. Now, this is the major session for Asia. It only has 6% of all FX market turnovers. Now, liquidity in this session can often vary dramatically in this market. Okay, and the most actively traded currency pairs are obviously coming out from the actual country that's open. Okay, namely the Japanese yen, and the major crosses during this session which are active are Euro yen, Aussie yen, Kiwi yen, Sterling yen, and CAD yen. Okay, anything with the yen in it is going to be extremely active during that Asian session. Now, the London session, which is the sort of headquarters, I guess, for the European session, it has 37% of all FX market turnover, good liquidity, and less volatile conditions. Okay, this is the premier market for the FX markets. the major focus are euro and sterling. Okay, they are the currencies, and also I guess you would also include the Swiss, but the Swissy generally follows the euro. The euro doesn't necessarily follow the Swiss. So when you're considering that, euro and sterling are the major focus for the currencies, but also looking at those currency pairs and those crosses which are active at that time: euro sterling, euro Swiss, and sterling Swiss, and also probably euro yen as well. Now, what you have to understand is with this time zone, it can often be difficult to trade on a large number of political announcements, as the various European countries like to counter each other. Now, we found this during the GFC. When you actually are coming into the, say, the European session itself, if there's any heightened political tension, it's actually a much more difficult session to trade, primarily because the finance ministers for different countries will generally counter each other's comments. There's a lot of animosity at the moment across Europe with regards who should be in the euro and who should be out. And that's what became clearly evident during the GFC, during sort of 08, in particular, where a lot of the political announcements will make it almost untradeable to trade during that session. Now, the New York or North American session has also a high level of activity, with 18% of all FX market turnover, good liquidity, and once again, less volatile conditions. But the most important part about the US session is, since the US dollar is the benchmark for most traded pairs, it is critical you're aware of upcoming releases. Okay, so what we can see is large one-way moves in the US dollar on economic data and political announcements. And because the US dollar is the benchmark for just about every currency pair globally, this is the session which has potentially the biggest impact across the board. Okay. And that's why we sort of should know that. Now, as far as the, looking at the hidden danger zones for the actual trading week, what you should be very aware of is the Monday open and the Friday close. Okay, so the Monday open in Asia, it starts with Sydney at 5 a.m. Sydney time. There's low levels of liquidity, high levels of volatility, and what you have to factor in, or the markets, and why that is so, because markets are susceptible to weekend news events. Generally, G20s are organised on the weekends. There's also, in this day and age, the 2-day event risk, where there's it's possible that we may see some terrorism or the like, which will impact the economic or the currencies very dramatically on the open. And a lot of these Chinese data is actually being released over the weekends as well. They're changing interest rates. It is impacting the currencies dramatically on the open. So this is one of the key reasons why we don't have run positions over the weekends. If you do have a long-term position on, generally we're closing that out Friday and replacing the order on Monday, sort of after a good few hours of the market being open. Now, the Friday close is very similar. Once again, low levels of liquidity, high levels of volatility. As I said, the G20s are on the weekends. You can sort of get some sort of harsh moves in the currencies coming up to the end. The 5 p.m. close in New York. Don't forget, when we hit 5 p.m. New York, Asia's already hit the weekend. The European week's over. They're already sort of switching off for the weekend as well. And you can often be left. I mean, after working in New York, I can tell you most senior traders are out of there by 2 or 3 p.m. in the afternoon. So you do find there's less liquidity at these times. So what times are we looking at? So Monday in Asia, generally what you're looking at is somewhere between 5 and sort of 10 a.m. Australian Eastern Standard Time. You would be sort of staying away from the markets, particularly from 3 p.m. in New York on Friday to the close. I wouldn't be sort of looking to get into trades anywhere around that time. And that's one thing we will be looking at. Yes, this webinar will be recorded, so there's you can actually review this later on. Now, one of the most important parts that we've got is the focus actually shifts with the time zones. Okay, the focus of global traders doesn't sort of just sit on the key currencies. All right, this is something that you have to be aware of. Trading teams do actually sort of change, and they have global trading teams, whether they're in Asia, Europe, or North America, and it's to take advantage of the time zone that's open. It doesn't mean that you don't trade other currencies, but understand the focus of traders will shift as the time zones change. The times that I was just talking about there are Asian, Australian times plus US, North American times. So I'm sort of covering all bases there. Now, as the focus shifts with the time zones, we have the Sydney session with the Aussie and Kiwi. Then we have the Asian session, or the pinnacle of the Asian session with the yen. The European session, the focus is on the euro, sterling, and Swiss. And the North American session, well, the US dollar is active as well as the Canadian dollar. And that's the sort of the focus and change in the general viewing of the currencies, how it changes through the sessions. Now, the major currency pairs, I'm sure you're all aware of these. Obviously, the Aussie, Kiwi, dollar yen, euro, sterling, dollar Swiss, and dollar CAD. These are the sort of our trading vehicles, okay? But they aren't all active at the same time, except for probably the US dollar during the North American session. Now, let me explain a little bit further. If we break it down into the currencies themselves, use the US dollar as the backbone, you can see which currencies are correlating with which currency pairs. So on the left-hand side there, we have the Aussie, Kiwi, euro, and sterling. And on the right-hand side, dollar yen, dollar Swiss, dollar CAD. So as the ones on the left are going up, the currencies on the right are going down and vice versa. And that's just a simple correlation factor. But now, as we go into the time zones, if I put the currencies back together again, now, as I was saying, the focus does shift with the actual time zones themselves. During the Asian session, we have the Aussie, the Kiwi, and dollar yen as the major focus. Now, why is that? Well, the direction for the US dollar during that Asian session is going to come from the Aussie, Kiwi, and yen. This is where the live economic data releases are coming out of. If there's any political news, it's going to come out of those sessions during that day, okay? During the, and these trading centres, this is what's in the pockets of those traders in those time zones. It's what they're affiliated with. It's what they have a feeling for and direction. Generally, these are the currencies. So if there is any movement during the Asian session, and particularly any change in the US dollar, it's going to come from those currencies specifically. Now, also during this session, if there is, say, some major movement on the Aussie dollar, then whatever happens to the Aussie, say it rallies, the US dollar will come off. It will come off against every other currency pair as well. So you can get an easy lead into, say, euro and sterling. If you see the Aussie moving to the top side, well, there's a potential chance to get into euro and sterling because they will lag behind the move. Okay? So you can, with these other sessions, if you understand how the currencies work, you can actually sort of find an easy lead in. Now, this goes on the same for the European session as well. Okay, we've got the euro, sterling, and dollar Swiss as the major currency pairs that are active during this session. Okay, so once again, the direction for the US dollar will come from euro, sterling, and Swiss. Economic data releases, political news, any of those sort of events will come specifically for those currencies. Okay, during this session, the Aussie, Kiwi, yen, and more so the CAD as well, the direction for those currencies will come from the euro, sterling, and Swiss. Okay, so once again, you can actually, if euro is, say, moving aggressively to the top side, just simply with those correlations, you understand which direction the Aussie and Kiwi are going to be moving as well, and also dollar yen, dollar CAD. Once again, you're going to get an easy lead into those currencies. Now, when we come to the North American session, it is probably the most difficult session to trade. There are no easy lead-ins. Okay, like as I sort of mentioned there before with the say European session, you see euro move, you do get this sort of a second chance move on the Aussie, so Kiwi, and the other currencies as well, because they will lag behind. Now, during the North American session, the US dollar is active, is the active pair, and when there are announcements out, the US dollar moves against every currency pair at once, okay? There's no sort of second chance here. There's no easy lead-in. You're either actively trading the US dollar or you're not, okay? If you miss the opportunities, generally they've gone and you're sort of sitting on the sideline. So it's very important to understand how to read and trade that economic data releases. Otherwise, you're going to be missing every opportunity during that North American session. Now, understanding how the currencies that are active do direct the sort of major trading activity and the direction for the US dollar during the, say, Asian session, as I mentioned, the Aussie, Kiwi, and yen will direct the direction for the US dollar. During the European session, euro, sterling, and Swiss. And this can make correlation trading a lot easier. So during the actual session that you're looking at, you should be looking at the sort of major currency pair here that is, whichever one is moving in which session, that should be the lead for the other currency pairs. You can get an easy lead in here with, if you do understand how the currencies behave in each time zone, it makes the correlation trading much easier to sort of manage. So currency pairs that are active. Now, during the Asian session, you don't go looking for trouble, okay? Well, this is actually for each of the trading sessions. But, the currency pairs that are going to be most active are the major currencies, the Aussie, the Kiwi, and the Yen, as I mentioned. Also, the major currency cross pairs that are active will be Aussie Yen, Euro Yen, Sterling Yen, Kiwi Yen, and probably you can throw in CAD Yen as well. And that's, basically once the Japanese session starts, the Yen is very alive. During the European session, you should really be focusing on the Euro, Sterling, and Swiss for direction on those currency pairs, plus the US dollar. The major cross pairs active at that time are Euro Sterling, Euro Yen, Euro Swiss, Sterling Yen, and Sterling Swiss. Okay, so they're the major crosses to be looking at that session. Now, during the North American session, what we generally sort of get you or encourage you to look at more so is, stick to the major currency pairs. The US dollar is the major event, okay? It's going to be moving against the major currency pairs. Now, these cross rates, even looking at the Asian ones and also the European ones, funnily enough, the sort of definition for a cross rate is any currency pair that doesn't include the US dollar. Now, if the US news is coming out and it's aggressively moving the major currency pairs, well, then the US dollar isn't a part of these cross rates. What you can actually get is quite muted moves in the crosses during the US session. So what we would sort of generally advise you to look at is stick to the major currency pairs. That's where the action is, the direct action. So when the currencies do move, you know exactly how far they're going and what's going on because the US dollar is the driving force. When you're looking at the cross rates during the North American session, it can be a bit of a mess because the US dollar is doing different things to different majors. There may be different extreme movements, and the movements on the crosses may not sort of actually make sense. Now, increased trading activity. Now, there's at the beginning of the session, there's generally an increase in volume as the time zones restart, traders rejoin the market. So I understand these aren't necessarily ideal trading times, and they aren't necessarily times that you stay away from, but they are sort of parts of increased trading activity that you need to be aware of. So at the beginning of the session, also on the release of economic data. Now, most sessions themselves, the European sessions, the North American sessions, and I guess actually New Zealand, most of the economic data comes out at the start of the session anyway. You look at the Australian market and the Japanese market, there's a little bit more data releases coming out in the middle of the day or in the afternoon. That's something to sort of be aware of. And also there's at the end of the session, as traders are squaring up and also, getting ready for the next bunch of economic data releases out of those centres. Now, I can tell you after working in banks a long time, the one reason at the end of the session, the beginning of the session, at the end of the session, the intraday limits that traders have when they're inside the banks, as in during the day, are probably, almost up to 10 times bigger than what they are during or once the session is closed. Once they leave the institution they're working at, their limits are somewhat decreased and they have a smaller overnight trading limit. Okay, so generally during the course of the day, they will build up positions and actually trim those positions before they actually leave the institution for the day. And that's one of the reasons why there's more activity at the end of the session. Now, if you understand the sessions, when you're looking at correlations against specific benchmarks, the idea of having a look at these different benchmarks, like I've got the Nikkei 225, the Dow Jones there, oil, gold, the dollar index, and the European stocks. What you want to be doing is when these particular, say, benchmarks are actually impacting the market somewhat, and we are getting some pure correlation directions out of these different benchmarks, you want to know which ones are moving in different time zones because as they open and shut, their importance and influence on the currencies will change. So generally during the Asian session, especially the Tokyo session, you would have the Nikkei up in the charts and having a good look at exactly what's happening on that and see how closely the yen is correlating with it. I think you'll find that the Nikkei and the yen have a very, very close relationship. During the North American session, obviously the Dow is a key feature, as is the S&P 500. During the European session, the dollar index is a key benchmark to have up on your charts, looking for those sort of movements related to the actual dollar itself. Obviously, with the euro being a major component of the dollar index itself, that's why the European session is the major session to be looking at with regards to that. Then also, I mean, you've got gold and oil, a couple of commodities there, which are, obviously during the Canadian session or the North American session, if you are looking at the Canadian dollar, you want to have a very close look at the oil. And then, then you've also got a few extra ones there as well. But understanding the time zone that's open and where these things impact is actually very critical to working out, what's going on. It's no good looking at, there's less impact. Say, for instance, if you look at the dollar index during the Asian session, if there's no major movement in the euro, but the Aussie, Kiwi and yen are sort of moving about a place, you're going to miss the sort of key moves if you're looking at the wrong benchmark. Now, this will sort of take you in understanding each session. You'll understand the currencies a little bit more specifically. And actually, there are more unique correlating factors that you need to consider for each time zone as well. Okay. The geographical location, of course, is a key component. Aussie and Kiwi have about a high 95% correlation, even in the short term. Euro and sterling, just primarily on their geographical location as well. And the Swiss have a positive and negative correlation, respectively. Then also looking at the specific commodities that these currencies have should determine during that time zone some of the commodities which you should be looking at. Obviously, dollar CAD and oil, as I mentioned, is a key one that you would be looking at. Also, during that Japanese session, they don't have any oil supplies there, so if there is any major movements in the oil price, it can impact the yen directly during that session. So, if we do see some activity in the Middle East or there's, some hurricanes coming through the Gulf of Mexico and we are in that Japanese session, well, then you'll want to be looking at the oil price because it is going to impact the yen. All right. So then also coming across, there's some other unique correlating factors specific for each time zone as well. Obviously, the US equity market, US equities and treasuries, and the relationship with the equity markets and the respective currencies. Now, generally, when I sort of look at the equity markets themselves, it's more the Dow Jones and the S&P 500 which are influencing all currency pairs. Okay, so the US equity market is the pinnacle of all equity markets. That's where the most sensitivity is. So generally, that will set the tone. So whatever happens usually in the Dow or the US equity market will be reflected the next day in the Asian and European markets. Okay, so that's what you sort of really have to be looking at as well. Now, understanding the economic data releases, each time zone has their own unique, the influencing the way these numbers come out is generally the same. Okay, so when you're looking at interest rate decisions, the central banks do things a little bit differently, and I'll come to that in a minute. Consumer price index, GDP, retail sales, unemployment rate and change, and consumer confidence. Now, these numbers are generally the same in each time zone. Okay, the one variable out of this is the unemployment change, which is different in the UK to everywhere else. Okay, so understanding the slight variations in the release of these key data releases for each time zone is very important. Now, as I said, in the UK they have the claimant count change, which is the sort of the reverse to the employment change. When we're sort of generally talking about employment change, we're talking about the number of new jobs in the market. When we talk about the UK and the claimant count change, it's the number of people who are actually collecting benefits. So during the UK session, if you're looking at the unemployment rate and change, then a negative number on the change, like there's less people claiming benefits, is actually a positive for the currency. Okay, it's very important you understand there's that slight variance particularly on that data release in the UK session. The rest of them are all quite similar. The central banks themselves are a little bit different as well. Okay, and I'll come to that now. So understand how each central bank operates. the RBA, RBNZ, BOJ, Bank of England, the ECB, the Fed, the Bank of Canada, the Swiss National Bank. These, the governors of these institutions are the kings of the markets, and they do actually do things slightly differently. Each time there's a different sort of release sequence with their rate decisions, their statements, their press conference, and their minutes. Yeah, it's very important with each time zone that you understand how these central banks do release their economic or their reports and their announcements. It's going to be key to you making sort of money. Now, going in with a sort of general casual view that they all do the same thing and at the same time, that's going to leave you sort of floundering when these key events are coming out. You've got to be quite versatile in your approach with each time zone. So getting used to the central banks is a key part to understanding how those specific currency pairs are moving and why they're extremely volatile or non-volatile at those times. Now, just coming through this, the whole webinar structure here with the time zone is actually very specific, so I'm not going to sort of bore you to tears. But one thing that you can actually do is with your, say, your MT4 platform itself, looking at the actual currencies is actually getting the time zones set up for the specific events themselves. And one key thing is organising your charts here, the area sort of with the purple band, organising your charts, in the time zones themselves as well. So then you can actually, as well as the currencies, is the key sort of component here. Now, on the left-hand side, we do have the currencies lined up. Now, the idea of lining them up, if I just zoom in here for a second, is actually we group the currencies together by session. So then when you're looking at the currencies and trading them, you can actually see movements, across the board at a single glance. If you have the currencies at the top and the bottom and all mixed up, well, then it wouldn't really make too much sense. So during the Asian session, we generally sort of encourage you to sort of put together the Aussie, Kiwi, and the Yen, group them together. Then you've also got the Asian currencies below those, below the rest of the major currency pairs. It makes it very easy to see what's happening in the Asian session when the majors are together with the crosses below those as well. Now, during the European session, we generally switch over and have the Euro, Sterling, and Swiss, in a line with the major European crosses underneath those Asian crosses. Okay, it makes it very simple to recognise exactly what's going on in the European crosses at the same time with the majors. Then during the North American session, last but not least, we have the dollar CAD as the last major currency pair. But during that session, the currencies that are active, the major currency pairs themselves are all active all at once. Okay, so this is what you should be looking at with those as the sessions change over. Now, also looking at the various sessions themselves, you want to focus on time zone changeovers. Okay, as I mentioned before, there's increased trading activity on the open, and also most economic data releases are at the start of the session as well. So if you are running positions in each of these sessions, understand what economic data is coming out, understand how it's presented in that time zone, because regardless of which currency pair you're trading, they will be impacted by whichever data release is coming out. Now, I'll come back to to a couple of those questions in a minute. It's quite easy to change the order in MT4. You just actually click on the currency pair and move it up and down. That's right, just drag and drop them. Now, coming across, what you should be really doing is getting organised with the economic releases themselves. When you're trading the specific time zones, if you're trading, you're sitting with a position at the end of the North American session, you're sitting there trading euro, or you've got a position in euro, you should be very aware of what economic data releases are coming out in Asia for that session, primarily because the direction from the US dollar can be changed from the economic data releases in Australia, New Zealand, or Japan. Okay, so having a good look through your week and your currencies, depending on what session you're going into, the currency pair that you're trading will, generally be impacted by what's coming out of that session. Now, if you can get a grasp of this and understand this time zone changeovers, you'll know exactly which currency pairs to look at for direction during that session. Okay, so, as I said, if you are long euro at the end of the North American session, you will be looking at the key Australian economic data releases, because what happens on the Aussie will impact the US dollar and impact your euro position. So, there's obviously no European data releases, economic data releases during the Asian session. So it's no point sort of sitting there with a blind eye to the euro when the US dollar direction is going to come from the Aussie, Kiwi and yen. And that changes in the European session as the euro, sterling and Swiss become the predominant currencies for direction for the US dollar as well. Now, if you can manage this, you'll be able to manage the sort of volatile market conditions where most traders will be stopping and stop trading as these time zones. We go, through one volatile session into a more modest, less volatile session. Most traders will be pulling out here because they don't understand the difference between the time zone changeovers and how the currency behaviour changes with each session as well. Okay, so with this sort of understanding, you should be able to trade through these events and manage the market a lot better. And this is where you'll have more consistent capital growth. Okay, this is where you can sort of, one of the hardest parts about sort of looking for a lot of the trading opportunities is knowing when to trade and when not to trade. Okay, if you walk into a volatile European session where there's, you've got 10 angry finance ministers from 10 different countries all arguing over who should be doing what, who should be in the euro and who shouldn't be, you'll generally get some very aggressive, volatile, choppy conditions in euro. And that's a session you probably want to sort of stand or stay clear of. But if you go into a more passive Asian session, then you want to make sure you're actually trading that session and probably potentially hitting the major economic data releases that are coming out. Now, if you are trading during the North American session, you have to be very aware of what's going on, economic-wise with regards to the Fed, also the political situation, because that's going to sort of matriculate through the whole market instantaneously. Now, one of the key questions I've got here, most of the big moves are in the US session. Why? Well, the key reason to that is basically a lot of the core, even since the GFC, most of the core energy that was coming in the market was from the US session. Okay, it started with the subprime crisis with the housing market, and then it sort of filtered into the derivatives, credit default swaps, US treasuries. So the US session itself, and because a lot of the wealth in the US at the moment is in the US equity market, that's why the US session is very much the major focus for global markets. Okay. Now, the Federal Reserve being the central bank for the US and the manager of the biggest sort of currency pair or the currency itself. Now, that's why the US session is a major lead for the rest of the world as far as global growth. If there is any sort of major crisis going forward, even looking at the US debt situation, it all revolves around the US dollar. So what you can actually have is one session in particular will be the major focus. Now, as that GFC rolled out into Europe, we found that the European session did become actually a prime mover of the market as well. So what you have to sort of really do is, because the major events or the major sort of, economic crisis is in the US, that's where the major activity is. All right. So, during that GFC, the Asian session was reasonably quiet because there was no sort of crisis in Asia. As you move into Europe, initially there wasn't as much activity. Then you come back to the North American session and it would kick off again. Then as the European session got dragged into the whole GFC, that session became a massive big one as well. Now, so when the European session starts, it is the biggest market. Then, especially during around midday in Europe, when the North American starts, that's probably the busiest time of the whole global markets. And that's when, most currency pairs are sort of whipping around the place. And depending on the level of crisis or political announcements, that sort of generally determine the amount of volatility in the market. Okay, so that's generally one of the time zones there, chaps. As I mentioned, the understanding the time zones, it's a key part to increasing your capital growth. There's a lot of simple principles. This is a core component of our expert trader program. So what we do is we spend a reasonable amount of time making sure that people understand the nuances of the actual particular markets, the difference in the characteristics of each market, and the key currencies during those time zones, which, like any sort of group of people, have a different personality, different liquidity constraints, different volatility. These things all have to be considered. The way the economic data is released, Also, the behaviour of the central banks and how they actually sort of release their rate decisions and announcements is also a key component to this. Okay, so that's pretty much that covers the time zone session. One presenter here says not to look at anything except the charts. Your views on this? Well, that's probably I would generally say a naive approach. If you're actually just looking at charts and you're not looking at any of the economic data releases that are coming out in those sessions, you are trading blind and you will get slaughtered. Okay, I can tell you now, if you just trade the fundamental releases by themselves, you can make a lot of money. If you trade the charts on your own by themselves without any factoring of any economic data releases and those sorts of things, you will get hammered, and it's just a ticking time bomb before you run out of money. Okay, you go back to trading in the early 90s, and sure, you probably don't have to worry about anything, just look at the charts. But this FX market is extremely dynamic and reactive, I should say, to the economic data releases. So coming into each session, it's very important you know what's on. You know, if you're looking at your technical charts, they don't give you anything except potential entry levels and exit levels. You know, if you're not looking at the central banks and what they're doing, then you're sort of basically guessing. Now, okay, so I know you're saying you traded for 30 years. I mean, I've been trading for 25, and I was the chief dealer of most of the banks I worked at for half of that time. I can tell you, anyone that was looking at the charts was a dinosaur. If you don't include the dynamic nature of technicals plus fundamentals, well, then I'm telling you, you're missing a key component of the market. You know, horses for courses. You know, we're not sort of trying to work out exactly who's doing what here, but I can tell you, if you're trading FX, it's a lot more dynamic than the old sort of trending stock markets. That's for sure. Okay, now just as a special for the FX Street members here, and also coming into the holiday season, we're going to be running a special holiday season 2-for-1 on the Expert Trader program. The idea is, you know, we are sort of doing a major launch at the start of 2014 to get people into the currencies and give them some expert trading. We are going to be offering as I said, a 2-for-1. Basically, you find a sponsor and you can come along for free. Attend any online or in-person expert trader workshop between now and January the 31st. We're going to make this offer. It's going to be available we'll be sending this out tomorrow. This offer is available until the 25th of December. So basically, we're offering a sort of 50% discount up until the end of January 31st. What we do have is, it makes it quite easy. During that holiday season, there are still a number of moves in the currencies, especially there's less fundamental news, so you would be concentrating on the technicals as we go through these time zones. We do have a very large suite of educational video database, 180 plus videos. You will also get access to our exclusive members area, including the live trading desk and resources, where we do actually trade the live economic data events. We also send out trade alerts via our mobile app, which is a key part to keeping our members in the loop into some of the key moves that are going on. And you can contact us via our website or information or info@tradersfortraders.com. Now, question time. So I've been answering a few questions as we've gone along here. So what we're sort of looking at is, okay, so yeah, as I mentioned, I mean, I'm not here to sort of tell you what makes one trader more successful than another, but I would generally say if you're trading in a dynamic market, you need to understand the fundamental background as well as the technicals. I wouldn't discount either of those, but I think you'll find you'll get a lot more directional moves out of the fundamentals. They actually are the key directions for the currencies. So, you know, just going with the technical view of the market is one area. I would say it's about 30 to 40% of your success comes from your technical skills. The 60% comes from the directional moves on the fundamental releases themselves. This offer is available. Yes, it is. Well, it's only available for the Expert Trader program. As I mentioned, this is the core program that we do offer traders. We'll be sending out an email. If you want to register for this, just jump on our website and fill out the details. We'll send you an email as part of the email out tomorrow. This Expert Trader workshop is the premier sort of product where we are running through our whole program. It includes 12 months access to the back end as well as the 6 months of mentoring from our senior traders themselves. Yeah, that's where you're going to get a lot more sort of understanding of the markets. We do start with the currencies. The Timezones is a sort of core component of that, looking at the technical and fundamental analysis, your capital management, which is the number one priority, giving you a strict fundamental capital management system. Also looking at the strategies. Trade execution is one area that we found that most traders actually struggle with. We have some proprietary trading software, which also is included in that package as well. Now, coming back, what are the key economic indicators for the Swiss? Well, let me just tell you, the Swiss is a different kettle of fish. Actually, the Swiss and the Kiwi are two currency pairs which are more following currencies than actual leading currencies. Now, the Kiwi follows the Aussie dollar predominantly, and the Swiss follows the euro. Now, generally, when we're looking at the Swiss, this is one of the core components you have to understand. Their economy, or their whole sort of industry, is pocket watches, knives, and watches, or you got watches, pocket knives, and chocolate actually. So there's not a lot of change in the Swiss. The Swiss National Bank only announce interest rate or have interest rate announcements 4 times a year. Where just about every other country in the majors, it's monthly. So the Swiss is a very small economy. When we're looking at key economic indicators, well, it's probably the same sort of ones that for everywhere else. You're looking at the sort of GDP or the CPI. There's a couple of specific Swiss numbers themselves. They have a bit of a zoo number as well. But I wouldn't get too caught up in the Swiss. When we are trading the Swiss predominantly, it's more technically on the basis of the Swiss chart, but more on the European fundamentals. Okay. So when we're talking about fundamentals, we are talking about news announcements as, economic releases as well as geopolitical announcements as well. Now, you need to be aware in each time zone. If you're going into a time zone that actually is a bit of a geopolitical ticking time bomb, well, you need to be aware of that primarily because the volatility in those currencies during that session alone will be a lot greater. Okay, so understanding how the politics sort of fits into the equation, and it's usually a mess, that's where you need to fine-tune those aspects. Yes, okay, so this is a good question. It's a good point, actually. One of the questions here, many pros stay out of the market when economic numbers come out, and they enter later. Now, that's actually a pretty good point. Now, what you will find is at varying times, say you're in a time zone that is actually quite calm and less volatile, there are opportunities to get into the economic data releases on the actual release of the data itself. Okay? At different times, though, when there's increased volatility in each session, it may be wiser to look to, you can trade the economic data live, but what you're generally looking to do is trade the retracements. Okay? You get that initial knee-jerk reaction, sort of 40, 50 points down or up. Then the currencies sort of react backwards, retrace backwards. That's when we're sort of looking to trade on those releases, and that's what a lot more professional guys do, because that's all you can do in the banks. Okay, you don't get the opportunity to sort of trade with pending orders. What you will be trading is the event live, looking for the major impact, looking for the retracement, then looking to get into the currency that way. Well, as far as for one of those. For those people that haven't joined us before, I have actually mentioned previously the candles. Well, the candles actually do tell you a lot, but unfortunately, the candlestick methodology doesn't include a consistent risk-reward ratio or capital management structure. Okay, so when you're trading using the candlestick methodology, you really you have to have a very small trade size. You have to spend several hours in front of the computer every day trying to sort of recognise which bars and which candles you should be trading and which ones where you should be putting your stop loss and your take profit. It's not consistent enough that I would sort of waste my time and energy on it. And the other sort of key factor after 20 years in investment banks on trading desks, I never saw a candlestick chart on any trader's desk. Okay, if you go across to the sales teams who are generally looking for a sales pitch, well, they have some candlesticks in there, and they sort of do refer to them primarily because they're selling. It's part of their selling pitch is to tell you a story, and you can get a bit of the story out of the candles. And specifically in hindsight, that's one thing you need to be sort of considering there. So I'm not trying to rubbish the candlestick method. It's just there's no consistency with the risk-reward ratio or capital management in that methodology, and it makes trading extremely difficult if you're using that methodology alone. Okay, so coming back to why, well, actually, oils, well, when you're looking at the positively correlated currency pairs, you're looking at, say, euro and the US dollar and oil. Generally what we're looking for is sort of general oil supplies in those specific zones themselves. So, like and the sort of components of what we've got with the European and the US dollar situation, it sort of swings around with also the currency correlations. Okay, so I think with it's just more of an historical perspective with the correlation with oil and the euro. It's not like there's a huge amount of oil refineries, in Europe itself, but the movements in oil and the euro itself is probably more of a reflection on the relationship with the US dollar and oil as opposed to sort of specifically euro. But once you put the euro and the dollar together, that's where you get that sort of positive correlation. Okay, so so just coming back down here through these questions. The meetings themselves are better for knee-jerk reactions. You do get knee-jerk reactions on these fundamentals. That's a very key thing. But understanding what time the economic data does come out in each time zone. Some of the sessions at the start of the session, some it's at the middle, some it's at the end. So you need to know when the actual session is going to be active. If there's a key economic data release coming out at the end of the Asian day, and there was a couple today out of China, the industrial production numbers and retail sales figures. Well, then you know that the Asian session for that whole entire day is probably going to be on hold until that economic data release. So understanding the session that's coming up, you wouldn't sit in front of the computer for 8 hours thinking, well, I'll sit here and wait for euro to move, when you know that the currencies aren't going to move until that specific data for that session comes out, and that's where the next movement for the US dollar and the other currencies will come from. Okay? And now, let me just get up my charts here. So what you want to be doing is just having a look at the core currencies here. As you go from session to session, understanding one of the core components of actually sort of being good at technical analysis is not only being able to draw these technical lines efficiently and effective. What you're looking for is the simplest technical lines, so you're drawing trend lines with everyone else. Now, one of the key questions I'm often asked is, when do you redraw the trend lines? Well, I can tell you at the start of each session, the start of a new time zone, that's when you redraw these trend lines, okay? Why is that? Because traders for that session redraw the trend lines at the start of their session, at the start of their day. So generally what we're looking for is, redrawing the trend lines at the start of the Asian session, okay? Then at the start of the European session, redraw them again. At the start of the North American session, redraw your trend lines again. Traders are updating their trend lines around these times, and that's what you should really be looking for. As you change time zones, update your charts. Change time zone, update your charts. It's quite methodical, this approach. Do I think Aussie yen can be used for risk on, risk off sentiment in the general market? It is a major move. What we're sort of seeing at the moment is the Aussie dollar itself is a probably better proxy for risk on, risk off. If Aussie's moving, Aussie yen's moving exactly with it. So I wouldn't sort of isolate Aussie yen as the main proxy for risk on and risk off at the moment. You're probably looking at sort of the Aussie dollar itself is probably the major principle for that at the moment. Now, a question here from Ray. Do you have a trade technique that minimises being stopped out or not using a stop loss at all? Okay, so every trade that we put on, Ray, has a stop loss. What we do have is every trade you put on should have a take profit and a stop loss, okay? Now, the biggest problem for most traders, why they don't make money, is they never take profit or they never maximise their profits. With a set trade plan, you should have a stop loss to make sure you ensure that the value at risk of your trading system is always consistent. You know exactly how much you have at risk, and this is how you can sort of run a consistent capital management program. If you don't have a take profit, you'll never take profit when the actual currencies are moving in your favour. Generally, if you're long, the currency will look the most bid and look the most aggressive at the top of its run. And then when it turns around very sharply, if you haven't got to take profit and locking in your cash, well, then you're going to be giving up half of your money just by, just being a little bit almost lazy in a sense. So the trade technique that we have, there's nothing that can really minimize being stopped out. What you should be assessing is the activity in each time zone, what is driving the currencies, and what is going, what's the major focus for each time zone, which currency is the most active. That way, when you're trading, you'll know which currencies to look at. So if you are getting stopped in and out on particular currency pairs in particular sessions, then you need to change that strategy or that currency you're actually trading during that time zone. There's nothing that you can really do to minimize being stopped out except running those stops, and that is something I wouldn't actually dare tell you to do. Now, what role do carry trades play given the globally very low interest rates these days? Well, generally, hardly at all. The carry trade is, go back into the early 90s when, say, for instance, the major carry trade was the, say, Aussie yen itself. Now, interest rates in Australia are around 17-18%. In Japan, they're around at 0.1%. That's where the carry trade made sense. So the carry trade these days, if someone's talking about the carry trade, give me a break. Interest rates are close to zero everywhere. In Australia, they're at 2.5%. New Zealand, they're 2.5%. In Canada, they're 1%. There's not much of a carry trade in that. So I wouldn't sort of get too worried about the carry trade sort of in this day and age. It's more, what you'll find is good momentum, risk on, risk off moves in some of these crosses. At the same time, you can diversify your risk in specific sessions by trading some of the crosses and specifically the yen crosses. Do you advise the use of any particular platform? Well, not really. I don't sort of really push anyone too hard at this point in time. We don't have a exclusive arrangements with any platforms. What you'll find is you'll use a number of platforms over the course of time. The brokers, they have a honeymoon period when you sort of seem to join up, and that generally, it runs out after a few months, and you can actually sort of get some very odd fills. Once you start getting some odd fills from your broker, it's time to change broking companies. Okay, so we're sort of getting a little bit off track here, but I can sort of run you through a few things. Every day, just looking at this sterling chart up here. Now, one of the questions here is, can I talk about bank stop runs? Absolutely. Now, this is what you need to be aware of. Every day when there's around these trend lines, 95% of all trading activity occurs around these trend lines. What you generally got is the bankers themselves are managing a huge amount of stop losses from all their various corporate clients and hedge funds around these trend lines themselves. So generally what we do have is a situation where when it gets close to the trend lines, the guys at the banks are actually trying to run the stops and push them through those levels. Okay, so this is why we don't sort of trade specifically on those trend lines themselves, because the bankers are actually trying to run the stops every day. Okay, it's a key function of the market, and you need to understand how they do it, how far they're trying to push it through, where they're trying to sort of exercise and trigger these orders all the time. It's a key component to understand the market, is understanding how the core players, the bankers, actually trade in it. I mean, it's a whole new topic, that one, I can tell you. So that's probably for another time. But otherwise, we'll get too caught up. So what is your entry technique? Well, Ray, that's actually a key component of the Expert Trader program. We don't, it's sort of a bit more proprietary in nature. What you would be doing is, all I can tell you as far as our entry technique, it does involve the technicals as well as fundamentals. Looking at trend lines themselves is one thing. Understanding how bankers actually interpret movements through these levels or when it gets close to these levels is another thing. All I can tell you is, without sort of giving too much away, is they don't trade at the trend lines themselves. Okay, we're not trading at the trend lines themselves. It's a bit of a way off, but once you understand how that behaviour works and how the decision-making process occurs in banks, then you're well ahead of the market. Do we trade futures? No, there's not enough liquidity in the futures markets these days. So there's more liquidity in the FX broking platforms these days. So there's no point in sort of trading futures. You have issues with rolling your positions over and delivery and all sorts of things. So trading the futures market was bigger in the 90s. We used to actually, if anything, trade the futures aggressively, primarily to, spoof the market and give the impression that the direction for the currencies was coming from the futures market, not the actual currency markets themselves. So it was more of a technique to fool the market as into where specific selling or buying was coming from. Now, let me just come back here. So, yeah, I've just spoken about the bank stop loss runs. As I said, that's a specific other topic and something you need to be very aware of. What is your advice on 5 candles or 6 candle wick chart? Well, I can tell you I don't use candlestick charts, and I've never seen a trader in an investment bank use candlestick charts, so I wouldn't even look at the candlestick charts, to be honest. I would look at hourly bar charts. That's all you need to be looking at, okay? What you're trying to do is do exactly and make decisions the same way the banking market makes it. They're looking at bar charts. If you're looking at candlestick charts, you're the only person looking at those charts, or maybe the odd sales guy in these institutions. Head and shoulder patterns, do I also look at those? Well, you can, but it's a bit old school. Okay, back in the early 90s, head and shoulders were like the premier sort of pattern in technical analysis. What you can break head and shoulders patterns down into just simple support and resistance, and that's what you need to be doing. Focus less on the pattern and more on support and resistance, and you'll have better results. Does the devaluation of the yen, is that favourable for Japan? Well, definitely. Makes their products cheaper. Any sort of sizable devaluation of any currency will make their products more affordable. They should be exporting more, and then basically you get sort of more export-led driven demand, and that's where you can see some major economic growth. So I think dollar yen, primarily should be around 160. It would give the Japanese economy a chance to recover somewhat and be competitive in the global markets. Do bankers day trade? Well, they do manage the days. This is a term that I actually do sort of stay away from. The whole terminology of day trading came out of the stock market. With that market's open at 10, close at 4. The FX market's open all day. It's open from Monday until Friday close in New York. So traders do actually trade the session. They do trade with bigger liquidity and bigger risk limits during the day. But they do actually trade the entire session itself. Now, if you're sitting here during the day and there's no actually major trading activity, say in one specific time zone, well, if you're just sitting and trading that time zone itself like day trading, then you're going to miss most of the moves, particularly if the US session is the most active. That's where the movements will be. So what they do is they manage the risk during that day. Then once their time zone closes, they run proprietary trading positions to cover all time zones. Okay, you're looking for those key trading opportunities around those sessions. What do I think about longer term pivots, weekly, monthly, yearly? Well, when we're sort of looking at key levels, we are looking at sort of daily, weekly, monthly charts. They are much more important. Generally when we see a change in the, say the weekly trend lines and those sorts of things, they are more important because that could signal a change in an overall trend move in those currency pairs. So you would add some greater weight to those longer term technical levels anyway. I'm not so sure about pivot points. I've never really, after doing this for 23, 24 years, there's about 10 different variations of pivot points. What we're sort of generally focusing on is key technical levels for those trend breaks. Do we look at the COT data? Absolutely. The COT data, the commitment of traders data, gives us a snapshot of the futures market on the close of business on Thursday. It's a very important component to keeping an eye on what the global market, how it's positioned. The COT data can give you a very good look at where potential sensitivity can be on specific currency pairs. So if you see, for instance, the euro market exceptionally long, you will know that if there's some very negative news comes out in euro, the market is going to move very aggressively because it's caught long, and it gives you a very easy trade into those time zones or into those specific currency pairs. So that's actually a key thing. Well, bankers do hold trades overnight. You may have misinterpreted me. What they don't have is they don't have as big intraday limits or overnight limits as they do during the day. So they do hold positions overnight, that is for sure. but they are smaller positions than they would hold during the day. Do bankers use indicators? Absolutely not. There's no mathematical indicators in there. What they will use is stochastics as a momentum indicator, but as far as looking at mathematical indicators themselves, no, they don't. Now, why is that the case? It's quite simple, primarily because the indicators are trying to tell traders who have got no idea about the market or the currencies or what's going on where to get in and out. Okay, there's a significant 3 to 4 hour time lag on most indicators. So if you're using an indicator as a bank, they are the market. They can't sit there and wait 3 or 4 hours for an indicator to tell them to buy or sell. And this is the primary reason why they don't use indicators. And if they're not using indicators, and don't forget the banks control 92% of all volume in the market. If they're not using indicators, then you shouldn't be. If you don't understand how to use the market, you should be jumping on our expert trader program and getting upskilled here to actually identify and read the market so you can actually place trades, analyze the markets the same way as the bankers, trade and execute at the same time that they do. What you'll find is you'll be moving with the market more often than not than against it. Okay, and that's the secret to doing this. That's right, because the bankers control the markets. The expert trader program is $4,975. So if you can actually get a partner or a friend and come along, you're going to be looking at sort of just under $2,500 for the premier product. As I said, this is going to set you up for long-term success in this market. It's understanding the markets is one thing. Understanding how the traders at the banks and hedge funds trade in it is a completely different thing. Looking at trade execution is absolutely critical, and a number of key components we have. The ongoing support package with the expert trader program, I don't think you'll find anything as comprehensive as this. As I said, learning through the holiday season is a good way to do it. It sets you up for a good start to 2014. As I mentioned, we do have a suite of over 180 plus videos on everything from the currencies, the time zones, to technical analysis, fundamental analysis, even covering the capital management and everything else as well. So what tools do we use to analyze? Well, fundamentally, we're looking at the central banks, the economic data. Technically, we're looking at the charts, also some of the cross currencies, and that's where we're looking at this. So what we are looking at, the cost of the program, depending on what location you're in. The expert trader program is $4,975. Generally, so if you're in the US, I think at the moment, if you're lucky enough to get in the next few days, I know it's supposed to be $4,975 US. At the moment, there seems to be a disconnection with the US bank. So depending on which, you could get a cheaper price, and you're obviously paying in Aussie dollars at the moment. So there's actually changes. What we tried to do is make it more consistent across each time zone, primarily because once the Aussie dollar was up at 110, you were paying a lot more US dollars for it. Do we have a trading room? We have a live trading desk, which actually covers live trading events. The desk is open on the high impacting events. We do have a forum which does have a chat room in it. We don't really encourage sort of the general dribble on chat rooms where, if a time zone hasn't got any major economic data releases and there's no major movement, you're wasting your time sitting in front of the computer. This is one of the key things we're going to teach you is, then one of the key things that you have to understand is how the currencies move in each session and what you should be looking for. We're going to train you to spend less time in front of the computer and make more money than you have before, primarily because you'll know which sessions coming up are going to be more active and which currency pairs are going to be trading more active in it. So how does one share with a pal? Well, basically, if you've got a friend who's interested in this, then clearly that's you would be hooking up with someone. If you don't have any friends, give us a shout. We might be able to hook you up with someone to split the cost on that. All right, everyone, that's pretty much a wrap. We're getting the call there from FX Street. We appreciate your time. As I said, if you want more details with this special offer we're having for the holiday season on the Expert Trader Program, drop us an email at info@tradersfortraders.com or just go to our website and we can give you some more details with that. I said this is definitely a one-off offer, and as I said, you've got a couple of months to sort of enjoy this program. We will be You can either do that in person or online, and it's all for everyone to take advantage of. Thanks, everyone. Appreciate your time. That was, trading the session, the time zones. It's a very interesting topic. The more knowledge you get about these time zones, the better it will be for everyone. Thanks, everyone. Thanks very much for your time. We'll catch you again next time.